Hey everybody, it's James here, and in this quick video, we're going to look at some Bitcoin charts. So Bitcoin obviously has had a pullback, which has some people nervous, has other people excited, depends on the side of the fence that you're on. But it's important to understand that what Bitcoin is doing right now is not in any way special or unique. What happened was obviously there's a move down, so there's a bear market, right? A 50% sell off roughly. And in bear markets, you will often rally back to the 200 simple day moving average, which is this blue line in the sand. Most often, when you first test the 200-day moving average, if it's sloped down, you will get rejected. It doesn't necessarily mean this is going to go even lower, even though I'm a bear, and I'll talk about that in a little bit. That's not what that means. That rejection right here, that's just a normal reaction in the market. It's not the magical line that matters. It's the reaction to the magical line. So when you see this, yes, this is a place where a trader may say, hey, I'm going to take a short, put a stop up above the 200 moving average. But this is not saying that Bitcoin is going to melt down 10, 20, $30,000. All this is saying is right here, there's probably going to be more supply than demand. So there's going to be an imbalance, and that's going to push it off a little bit. And in this case, all it did so far was push it back down to this high. So I didn't take a short there because I wasn't trading Bitcoin. I'm still in the short that I took back around 90 something thousand dollars. If I had taken a short here, if I was in a shorter, like a swing trade, I would be closing that short right now, not because I'm a bull, but because the imbalance has played out. It moved from supply back to demand. So that's the trade. That's the 200-day trade setup. It's done. It's over with. What's happening now is it's retesting its 50-day moving average, which used to be a really good line in the sand on Bitcoin, but the last few years, Bitcoin's just like, I don't care anything about this level. It just completely ignores it. And so almost don't even really need to look at it. More importantly, it's retesting the top of this range back here. And so if this was some type of accumulation, which I don't think it was, but if that's what it was, then the most likely outcome, or the outcome that bulls would hope for, would be this. And that's possible. It's not what I think is going to happen, but it is possible. So on the daily chart, that's what I'd be watching for, is how does the market react to this level? The bigger problem that I see is initially on Bitcoin, I was thinking, hey, we're going to melt down to around 37,000. That's the theory that I put out in the fourth quarter of 2025. And it was 37,000. I was looking for a retracement to this 80% level, which I still think is the minimum that's going to happen. But since then, some other things have come into play. First, we had this flag here, which looked like this. It bounced off the 80% level. So again, from a trade perspective, I really should have closed my trade at the 80%. That's my rule. It's why it's yellow, but I didn't. And I just kind of said, you know what? I always close these shorts early in bear markets. I never catch the full move. I'm going to try to catch it. It's a small trade anyway. It's not even a big deal, but we'll see what happens there. So the flag is pointing to 52K. It got front ran at the 80% level, which again, I had that highlighted yellow because that's when I trade those typically where I take profits. The 1.618, which can sometimes get hit in a strong trend, is down around 24K. And the reason that level is interesting is because it's really retesting the demand from 2022. And that is a very similar setup to why I called for the 4K lows in 2019. So in 2019, in August, I said I thought we'd go back down to 35 to 4,500 because I wanted to retest the demand zone, right? This area back through here. And of course, at the time, people thought that was unlikely to happen, but it did happen during the COVID crash. And so now it's kind of a very similar setup. This is the demand zone. The 1.618 is pointing there. It's roughly 23.9. But now we have something else pointing there, and that's this. This is starting to look like a bear flag on a monthly time frame. So if I draw my flagpole, just this one move down, these 5 red candlesticks, and then if this was my pullback, that's giving me a target of 16.5, which is almost perfectly lined up with the 2022 bottoms. That's going to be a really, really strong level if price moves there, because a lot of people are going to be waiting, especially bigger money they look for those previous lows, those previous bear market lows. And so it's going to be interesting if it gets there. Now, some people are going to say it can't get there. That's just too far. It can get there. I don't know if it's, likely to get there. I tend to think it is, but it can get there. It would be a drop of about 87%. Bitcoin has had larger drops than that in its past. And the big thing to remember is people are looking at the institutional money saying it can't go lower because there's institutions involved. But it's actually the exact opposite. So the institutions, a lot of them, they're not actually buying Bitcoin for themselves. It's not a decision that they're making for themselves as much as, it's like they're creating these ETFs. And so you have retail investors buying the ETF, and then the ETF buys the underlying asset, in this case, Bitcoin. They'll then move those Bitcoin off of the exchanges and they'll move them into cold storage. And so if you look at the on-chain metrics, a lot of people are like, well, there's more and more cold storage than ever. But what I had said a few days ago on Twitter was that you can't use that as a metric because those very same ETFs will dump those back on the market if people start selling off the ETF. So this is what I was saying in that post. We don't know what the ETFs are going to do in a true risk-off environment because they have not existed in such an environment yet. And it's ironic that I posted this yesterday because today this article pops up on TradingView. Bitcoin slide extends as record ETF outflows. So we haven't even entered a true risk off phase, but just the threat of that phase with the likely rate increases has already caused ETF outflows according to this record levels. The most likely outcome in a risk-off environment or a macro bear market, the riskiest assets get dropped first. And that's not riskiest by narrative. It's riskiest when you look at the metrics like the Sharpe ratio, for example. And Bitcoin is one of the riskiest assets. And so I really, truly believe that if we get a macro bear market, which is looking more and more likely, that we will see major outflows, which is going to be major supply. And I think demand's going to have trouble absorbing that. A lot of people right now seem to be a little bit confused. You've got Michael Saylor and Strategy, buying all kinds of Bitcoin, and they're like, why is price going down? Price is going down because there's more selling than buying. That means that the supply is absorbing all of the demand. And that is a telltale sign that we may be in distribution, which is a theory that I put forth late last year. If we look at the dollar cost averaging returns, this is a fair look at Bitcoin. Instead of saying, well, if I bought on January 1st of this year and held it, I'd be up this much. This chart or this table works like this. Each row assumes that you started investing on the 1st of this year and invested on the 1st of every month thereafter, equal dollar amounts, your cost averaged. So for example, the dollar cost average returns, the annualized returns, starting in 2014, you would have made about 61%, 64% if you started in 2015 because you would have started at a lower price, and so on and so forth. And there's a very clear trend here. The returns are shrinking. By 2021, if you started there, your average annualized returns about 15%. 2022, it's about 11%. If you started in 2023, you would have been buying right near the bottom of the bear market. So basically perfect timing. You bet 38%. 2024, you bet 19%. And then of course, if you started in 2025 or 2026, you'd actually be experiencing a negative annual growth rate, which is, it's a little bit unfair. And I want to be very clear about that. This is because we had a top 7 months ago. So these last two numbers aren't something that you really need to get super panicked about or super excited about if you're a bear. It's just kind of a weird look. So what I did was, because I didn't want that to kind of be skewed data, I pulled up another table, or I created another table with data. And essentially when I did this, which was yesterday, we were 224 days post all-time high. And so the annual growth rate, if you'd have started investing in January of 2024 to now, was about 19.2%. If you did the same thing in the last cycle, 224 days post high, you would have been experiencing returns of almost 40% annually. If you did in the previous cycle, you would have been experiencing returns of 271%. If you did it in the previous cycle, you've been experiencing returns of 745%. And I want to be clear, this is not, hey, if I bought here and just kept buying, this is not using $100,000 Bitcoin or $80,000 Bitcoin. This is based on the price 224 days post all-time high. So for example, 19.2% is based on $77,000 Bitcoin. 745% was based on $634 Bitcoin that started at $4.58. And so what you see is the same trend. You have diminishing returns on Bitcoin. It is extremely unlikely, in my opinion, that this suddenly changes course now that Bitcoin has left the price discovery phase and it's basically a mature asset. Bitcoin has a market cap of about 1.5 or 1.6 trillion, but that's kind of an inflated number. There's actually roughly $1.1 trillion of capital invested in Bitcoin. And you have to realize that there's about 750 billion in SPY and about 500 billion in QQQ. So Bitcoin is actually larger than SPY and QQQ put together. Now that's a feather in the cap for Bitcoin people because it's obviously it's a legit, asset in most people's eyes now. But at the same time, because it's so large and because there's so much money already invested, it takes an enormous amount of money to move the price. If you look at it in a super simplistic view, it's like double the market cap, but it's not really double. It doesn't actually take 1.6 trillion to move it. It's kind of an oversimplification, but it's a good rule of thumb, essentially. It's safe to say that it takes an enormous amount of money to move Bitcoin. That's why you're getting diminishing returns. And if Bitcoin were to double from here and go to say 150,000, guess what? It would take even more money to go from 150 to 300,000. I think for Bitcoin bulls, what they really should hope for is for my theory to play out, for this to actually drop back down to those levels. I actually don't think it's off the table. I think there's a tail risk that we actually drop down to $10,000 again if we get a serious global bear market. And by serious global bear market, I mean the QQQ melts down at least 50%, and more likely it would take an even bigger meltdown, maybe like 70 or 80%, something more like the dot-com bubble. I think Bitcoin goes sub 10K. If QQQ, maybe does a 35 to 50% bear market, I think it's potentially likely that we drop all the way down to these $16,000 levels. The thing about that is it will break the narrative on Bitcoin, the 4-year cycle narrative. And so I think a lot of people will flee the space. But I do think at this point, with the institutions involved and everything, I think it's gotten big enough. It probably will survive. And I think it will move back up. I don't know if it'll ever eclipse 126,000, but it wouldn't shock me if Bitcoin fell to 10K or 16K. It would not shock me if it went back up to 100,000 in the future, maybe 80 to 100,000. And so me personally, I would be interested in taking a look there because guess what? It's a lot easier to make an 800 or 900% return going from 10K to 100K, right? 900% bump. That's way easier than going from 100K to $1 million. Bitcoin has continued to struggle when we price it versus the QQQ. We can see that even during this nice US dollar rally, it actually just moved sideways. It really didn't do much versus the QQQ. So, that's obviously relative weakness. Bitcoin has looked pretty bad versus gold. So all these charts are like larger time frame analysis. I think the one that's most interesting or most maybe scary, if you want to look at it that way, gold is pretty scary because it's actually sitting back near the 2017 highs. But the one that's really, really interesting is this one. If you measure Bitcoin versus the semiconductors, it's actually sitting well below the 2017 highs. In fact, it's down about 64% from the top of the 2000 bubble. And so that's pretty interesting. And if you measure it versus like NVIDIA, which is of course, the darling of the AI world, it's actually lower today than it was at the peak in 2013. In fact, it's down about 56% from its 2013 high versus NVIDIA. And what that means is you would have been better off at almost any point in the last 13 years to put your money in NVIDIA instead of Bitcoin. And that's not even including dividends. And one last thing I want to mention that a lot of people don't understand. Right now, the yields on bonds are high. They're actually at the highest levels, I believe, since 2007. Like the long-term treasuries are paying like 5+%. And people are going to look at that and say, well, 5% is terrible. The market average is 10%, and Bitcoin has done this, and this coin has done that. But long-term investors and people like, reaching retirement age or people that are kind of on a fixed income type of portfolio, they're not chasing risky gains. They're chasing safer gains. And the boomers, for example, which I don't like that term, I find it derogatory. I'm using it as a generation, the baby boomer generation. They control most of the wealth. They've had their whole life to accumulate that. Most of them are not going to be taking a lot of risk in the markets. And so when bonds start paying high yields, a lot of them are going to be enticed by that. And you may see capital rotate into bonds and out of risk assets because a 5% guaranteed return, what a lot of people don't understand, it's not just 5%. If I buy a bond, for example, if I buy an ETF for a bond, right now it's $83, right? This is the 20-year Treasury bond ETF. So if I buy this, I'm going to be getting roughly 5% return passive income. But then if rates go back down, which eventually they always have, if the rates go back down in the future, guess what happens to this bond price? Every 1% drop in the rates, this bond price goes up roughly 15%, which means that, for example, if we get a 2% drop in rates, this bond will actually jump up to about 110 to 120 bucks. So if I buy this now, I'm guaranteeing myself 5%. And then in a number of years, maybe 2, 3, 4, 5 years, it stands to reason that there'll be a good possibility, not a guarantee, but a good possibility, I'll be able to sell it for like 110 to 120 bucks, which means that I'm going to make a capital gain of maybe 30 to 50% while also getting a 5% passive income. That is very enticing. It's enticing to me. I'm not, a baby boomer, but I am in a point in my life where I'm more or less risk adverse, and I'm in more of a capital preservation mode than I am a high growth mode. And so if I see this and I see a chance to make 5% guaranteed and a chance to possibly make a capital gain later, that's way more enticing to somebody like me than risking money on Bitcoin, at least dollar for dollar, right? But I might risk, if I was willing to risk $100 on this, maybe I risk $1 on Bitcoin, because I do still hold a tiny, tiny bit of cryptocurrency. But for the larger investments, I want the safer bet, especially for somebody like me who believes that, most stocks are overvalued. So if capital rotates over to the bonds, it'll pull that capital out of those other markets, and it'll actually help bring them down. If you enjoyed the video, make sure you give it a thumbs up, make sure you subscribe to the channel, and please share it with a friend. I'm really struggling to get enough views to justify the effort that goes into recording and editing these videos, so every share really does help, and it helps to ensure that I continue to create content. Please remember that I am just some guy sitting in a spare bedroom. Nothing in the video is financial advice. You should always go out and do your own due diligence and seek out professional financial advice from a licensed financial advisor before making any type of investment in cryptocurrency, the stock market, precious metals, Forex, or any other tradable asset. Thanks for watching, and as always, please remember to trade safe.